thanks for coming today, guys. Just wanted to chat a little bit about what we're seeing in the market. How are your buyers and sellers feeling? How are your neighbors feeling? And what are you seeing in the market as we kind of come into the summer, which is traditionally a slowing down? So what's the biggest impact you've seen and the biggest surprises you've had this year?
Well, Adele, thanks for having us today. Hans and I are very happy to join you. First, before we start on the market, I'd like to ask whose hair is going in the wrong direction faster? Adele.
The part? I see a little more gray than I'm used to seeing.
Yeah, absolutely. So, yes, I'll as you know, Hans covers more of the DC, Maryland side of things, and I'm on the Virginia side of the river. So I'll speak to the Virginia side. Definitely, the market is affected by what's going on, understandably. I've been tracking pretty much on a daily basis what's been going on. I've been following, what I think is the most interesting metric is the number of contracts that are happening. So I picked April 1st as my demarcation for what's happened after April 1st compared to this time last year. And just to give you an idea, and I broke up the markets between 1.5 million and under and 1.5 million and over. And in Arlington, the market's down about 33% under 1.5 and 34% over 1.5, which is interesting because when we first started, it was that divergence was much greater, meaning the low end of the market under 1.5 was around the 30. We'll start at 50%, but then 30%. Whereas the high end of the market was over 50% down, and now they've converged, and so we're seeing the high end of the market's catching up. And then in McLean, similarly, the market's down. It's actually down a little bit more than Arlington. It's down about 47% under 1.5 and 51% over 1.5. So what's interesting about this market, and I'm curious to know what Hans thinks.
When you say it's down, is it down unit sales or volume?
I'm counting the number of deals that have gone under contract. So
units.
Good question. So how many deals went under contract this time in the same period last year versus this year is what I'm measuring. What I'm seeing in this market, which is different from other market shocks that we've had in our career, is that where usually you have an effect to either supply or demand. In this market, it really is both supply and demand are both being affected. So said differently, buyers are only buying if they have to buy, and sellers are only selling if they have to sell for the most part. So that's sort of shrank the overall market. But as we all know, life happens, and what I'm hopeful is going to happen, and what I'm starting to see with these numbers is what normally is our spring market, which would have been April, May. I think it's going to be shifted to after Memorial Day. So we'll have a late spring this year.
Awesome.
It's funny. I think Stephen summarized it well. And what we're seeing sort of in a visceral level, the number of buyers and sellers have both gone down on this side of the river as well, but they've gone down in different ratios. And we're actually finding now that there are more buyers in comparison relatively to the number of sellers. So it's become very much a seller's market because there's no inventory. And we have, just this morning, I've got three agents calling me asking for if I'm aware of any opportunities in our neighborhood because there's just nothing available. To Stephen's point, that's very much true in the homes under 1.5, 1.6, and it starts to level out a little bit around 2 million or so, but we're seeing signs of life even in the upper brackets now. And I agree. I think Memorial Day this year, rather than being sort of the the start of the slowdown in the spring market for us is going to be the kickoff of the spring market for 2020.
Great. And what impact are you seeing in home sale prices in relation to this supply and demand differentiation?
We're seeing prices up materially in upper Northwest Washington, close in Bethesda, Chevy Chase, for sure.
Mm-hmm.
My answer will be a little more guarded than that. I do think in the under 1.5, we've seen a lot of bidding wars happen this year, but everything that's happening right now is through a veil of caution.
Mm-hmm.
So whereas a buyer, 3 months ago may have gone, escalated, very aggressively, now that escalation is done through like, a shrunken, stock portfolio and, fear of economic downturn down the road. So everything is just a little more cautious. I'm always hesitant to say what's happening while we're in it, because it is really tough to say like, will prices go up or down? But I do think, given what's going on, properties that were priced, I think of pricing properties as a range, a reasonable range. Properties priced in the mid to low end of that range actually do better than properties priced in the middle to the high end of the range, because buyers in this market, they're willing to go after things, but if they're feeling like they're stretched, they might be a little more cautious than they would have been 2 or 3 months ago.
Mm-hmm. Are you noticing, as you work with your buyers, any specific priorities of the types of home or the types of shopping experiences that they're having? Or is it, in terms of the home shopping experience and their must-haves and want-to-haves, is it business as usual, just a little bit more guarded and safe?
So I'd say that I think there's sort of 2 questions embedded in there. So one is sort of what's different today than it was, pre-COVID, and a lot's different. So one is, I think buyers are taking a lot more effort to vet a property before they actually are willing to leave their house to go see it, which is great. And I think for the large part, the agent community has done a really good job of providing more information and photos and videos about properties, so buyers can really have a good sense if it's worth the risk to go out of their house to see a property. And then in terms of what they're actually looking for, Hans and I have written a couple pieces on it already, but we do think sort of a shift in how people view homes has changed. And I think this might have a long tail on it, which is, whereas we've, in the last 10 plus years, we've seen sort of a trend of people wanting to be in more highly dense neighborhoods and walkable to commercial centers. We think that this shock is going to sort of shift that trend, where people want more destination homes where they can work from home and have whatever amenities, outdoor space, or swimming pools, or whatever it is that's important to them. So we think there's going to be a shift to the suburban. And then the last piece of your question really goes to the actual process of showing a home. And I think it's been really interesting, both on the listing side and the showing side. I think the community's been really good about it. Like it's become a very safe thing to do, or I should say, controlled thing to do. So you can, sorry, my printer decided to reboot or whatever it's doing, but we're using all the recommended safety protocols in terms of no touching and wearing masks and using disinfectant, and being very careful with the showings.
Hans, is that in line with what you're seeing on your side of the river?
Stephen talked so long, I forgot the question.
Just so it's a 2-sided question. The first side is sort of, what is the day-to-day experience like with a buyer that's different from how it was before? And then in addition to that, what they're searching for? Have you seen any changes in what people are asking for in their must-haves or want-to-haves?
Yeah, I mean, absolutely. I mean, this process, this environment is distilled serious buyers and serious sellers. So we had a listing that went live on the market Friday. We had 3 showings over the weekend and 2 offers. So the buyers are coming out are serious, and the sellers are serious. So things are, people playing less games. They're more realistic, I think, both on both sides of the equation. So while some of our work is more logistically challenging, the parts of it have been streamlined quite a bit. In terms of what they're looking for, before walkability and people were willing to sacrifice a lot to be in a walkable neighborhood to retail and all this stuff. And I think recently in the last 2 months, people are reevaluating that trade-off and are going for more space. Generally means more interior space, a yard versus a semi-detached or a condo, and willing to be 5-10 minute drive from retail rather than having to just walk out your back door. So I mean that's at a high level. I mean there's idiosyncratically buyers are looking for specific things, but at a high level that's what we're seeing.
So Hans, I'm curious because I've certainly seen it on the Virginia side. For the listings that are sitting out there, I'm starting to see bid-ask differentials that are far greater than we would have normally seen. Whereas a buyer in other markets probably wouldn't even bother to writing an offer that was 10, 15% plus below asking. In this market, I'm actually starting to see that over here. Like people just like, I'll throw in a really low offer and see what happens. Are you seeing that on your side?
Yes, but primarily in upper brackets. People,
Right.
buyers are hoping to catch someone in a liquidity crunch, so yes.
What about your new construction? Are the builders still taking down lots and starting spec projects, or have they hit the pause button?
I think the builders we're working with are still actively looking. We're very much in a inventory constrained environment, so they're still looking. They might be a little bit pickier. They may pass on the marginal opportunity, but if there's a good opportunity, they're still, everyone I've seen and talked to is fully engaged in it.
Yeah, I definitely see it probably a little more of a slowdown on this side of the river. I mean, a great lot is always going to go in this area, but the marginal opportunities, I think the list of things that builders might pass on has gotten greater in this COVID world.
Yeah, and maybe on the margin. Honestly, what I think we're going to see the biggest fall off for sure is in the condo development. There's so much inventory all over the region, and I think there's going to be a real shift away. I think people are going to be less excited about being in buildings with elevators and density, and there's already an oversupply in that market, and we're seeing that's the one segment that from a pricing perspective, and I just think it's going to take a couple of years to shake that all out when get through all this.
It's interesting. I mean, I'm just trying to think off the top of my head. So in Tyson's, we've had the Signet. I mean, we've had the Monarch and the I'm blanking on the other one in Tyson's in the Borough complex. But then in McLean, we've had the Signet, and then in Roslyn and Arlington, we've had the Pierce condo development happen. And so it's just, there is a lot of new condo development that, these have such a long run rate that it's, you can't really stop that cycle. And the one in Roslyn, it's sort of a competition for the Turnberry, like a high-end concierge-like building. But those, it's going to have a 2 to 4 year sales cycle, and maybe longer now, given what's going on.
Yeah, I mean, talking to our peers in New York, it's just a bloodbath up there, and I think that's going to sort of be a harbinger of things coming to these other major metros. It's not just a DC phenomenon or a New York phenomenon. It's just this pandemic's changed buyers' preferences, and I think it is going to have a long tail. So,
interesting. What would you guys say to someone who had maybe been considering a move up or a relocation at the beginning of the year and is maybe reconsidering it now in light of what's happening? What would your advice be to them either way?
You know, honestly, people, it still shocks me, but the most important question for a buyer is, what is their time horizon? You know, if they're going to be in this market for the foreseeable future, meaning, 4 or 5 years plus, and they're at a point in their life where they can want and can afford a home, and the next home, whether it's going from rental to a first time purchase or a move up purchase or a downside purchase, then that's the time to do it, because you can make all these predictions and you can try to predict what's going to happen, but you can't predict. No one can predict this pandemic, right? But what you can predict with more certainty is that, yes, we're at a stage in our life where we know we want more space, we want a yard, we want whatever, and we're going to be here for the next 5 to 10 years. Okay, well then let's find in this market the best opportunity we can for you, given the market dynamics. And it can take, it's not easy to find a home that checks all those boxes. It could take, it could take a month, it could take 6 months, but look seriously. I had one friend who's a wonderful guy, but he'd been his kids went to school on this side of the river. They lived in Virginia, and they were for 6 years thinking about making the move to the side of the river. They ended up renting for a year and a half, ended up getting a good opportunity to buy the place they were renting, bought it. This is a 6-year process, bought it, and then 2 months later decided they want to move out west. So they made, they were so worried about all these little decisions, but they missed the big one, which is, we always talk about, with our clients, is like, that's the one you got to get right, because if things go against you and your timing is short, that's when you get financially hurt. But if you enjoy a home for 10 years, even if the value goes down a little bit, it was a good trade, if that makes sense.
Yeah, absolutely.
Was Hans saying something about my answer being too long?
At the end of this, we're going to time my answer and your answer, and it's like 4x.
Oh my gosh. Did you not hear the bell? The bell told you to stop talking.
Ding, what?
Yes, I would add to that, almost summarize it, is the same thing on this side. Like, trying to time the bottom is usually a bad exercise. So even if someone's really convinced themselves that the economy is going to, go down and bring the real estate market with it, and that they'll be better off buying next year than this year, well, that may be true. Like, interest rates can offset that very quickly. So if interest rates shoot up, a point or more, whatever perceived cost savings you get in price, you might pick up with your payment. And there's a saying in real estate: you don't live with the price, you live with the payment. And so, we're at historical low interest rates right now. So, timing the market is not the way to think about it. The way Hans framed it is the right way to think about it.
Awesome. That's great. Thanks, guys.